Hey everyone, Mortgage Nerd here. It's official. We're in a rising interest rate environment. Yeah, mortgage rates have gone up. They're not for the most part in the twos now, they're for the most part in the threes. It all depends on your case. Every APR is different too. I'm not quoting any one individual rate, just telling you overall what the market is doing. I had a client today say, wow, rates are so high because I quoted at 3.375. It's like, oh my gosh. Throughout history, who would have loved to have had a 3.375 when rates were 5 and 6? Or how about those of you that remember when it was 18%? Yeah, come on. 3.375 is not high. It's just when rates were in the twos, it seems like it's higher. It's all perspective. But a year ago, a rate in the low threes would have been amazing. It was amazing. I refinanced a bunch of my friends there because I was like, you have to do it at this rate. Either way, let's look at what's going on with the charts. All right, so we see today is a good day. Mortgage bonds are up, the treasury's down. This 1.7, we'll get to the treasury in a minute. That 1.7 is not good. So you can see here, I've made other videos since this time around Valentine's weekend. That's where it really started. I locked in some people right here, and that's it. Off to the races. We had this daily moving average crossover, another daily moving average crossover. I mean, just like long-term trends turning around, and just hasn't stopped. We've come down to these areas here. In the past, we have drops and we have bounces. Look at this. Drop, bounce, drop, bounce. We're not getting that. Look how long this has been. There's a couple bounces in there, but overall, it's just been a big drop. Look at all the crossovers on these moving averages. So now we're looking at the 10-year treasury right up here, the 1.7. Back when it was flirting with this level of resistance, the 1.6, we knew once it broke through, it was tough times. That's what happened. Luckily, we've been bouncing in this little range here. This has proved to be a good level of resistance, the 1.75. It's not a Fibonacci retracement level. That's these here, the 23.6, the 38.2. But it's a good level of resistance. We've really just stopped right there on that 1.75. So that's keeping us in this tunnel, in this sideways range where we're just going up and down within it. That's good. It's kind of predictable. So when I see someone go up to the top, let me show you. When I see someone go up to the top here, it's like, okay, well, there's room as long as we maintain this channel where you could come back down and I could lock you in. Now, as this moving day average comes in here, it also creates a different resistance that makes that channel a little bit smaller, but it also reinforces it. So the chances of that going down and breaking through the two levels of resistance with inflation and all the money printing and all the stuff that's going on, the booming economy, improving economy, people getting back to work, all that stuff, it leads me to believe that those rates are behind us. Anything lower than what we have today is behind us. Now, does it mean that the person I quoted 3.375 can't get a 3.25 in the next couple weeks because we're doing that up and down? We probably can. It's all about timing it at the right time, that right moment, and really getting it there for that person. And that's what I do that others don't do. Phil Stevenson, Mortgage Nerd. Here's your rate update for this week of April 5th. Phil Stevenson, out. Thanks.